What if I told you that every time a government builds a road or a company opens a new factory, they probably borrowed money from investors like you? A bond is simply a loan. The issuer, a company or government, borrows money. The investor lends it. In return, the issuer promises two things: regular interest payments, and to return the full amount at the end. Every bond has three numbers you must know. Face value, the amount borrowed. Coupon rate, the annual interest paid. And maturity date, when the issuer pays everything back. Think of it this way: your friend borrows 1,000 euros, promises 40 euros a year for 5 years, then returns your 1,000 euros. That's a bond. Now scale that to billions, and add an ISIN code, and you have the real bond market. In the next video, we'll look at exactly how those interest payments, the coupons, actually work in practice. A bond pays you interest, but how often, and how much? It depends entirely on the coupon structure. Fixed-rate bonds pay the same amount every period, predictable and simple. Floating-rate notes reset with market rates, great when rates rise. Zero-coupon bonds pay nothing during their life but are bought at a discount and redeemed at full face value. Most bonds pay coupons twice a year, semi-annual. Some pay annually, quarterly, or monthly. The frequency is fixed at issuance. Here's what trips most people up: accrued interest. When you buy a bond between coupon dates, you compensate the seller for the interest already earned. The quoted price, the clean price, doesn't include this. The dirty price does. In settlement, you always pay the dirty price. Clean price is what you quote. Dirty price is what you pay. Remember that distinction. It matters every single day in bond operations. There is one relationship in bond markets you absolutely must understand. Prices and interest rates move in opposite directions, always. When market interest rates rise, new bonds offer higher coupons. Your existing bond, paying less, becomes less attractive. Its price falls. When rates fall, your bond's higher coupon becomes more valuable. Its price rises. It's a seesaw, one side always moves the other. Yield to maturity, or YTM, tells you exactly what your investment earns per year if you buy the bond today and hold it to maturity. Collecting every coupon and the final redemption. It's the single most used metric in fixed income analysis. The spread tells you how much extra yield a bond pays versus a safe government bond, a direct measure of risk. Duration tells you how much the price moves when rates change. High duration means high sensitivity. Rates up, price down. Rates down, price up. YTM is your real return. Spread is your risk gauge. That's the fixed income toolkit. Not all bonds are equal, and in transaction monitoring, the type of bond you're looking at changes everything: the risk, the rules, the settlement infrastructure, and the red flags. At the safest end, government bonds. Backed by a country's ability to tax and print money. Then supranationals, like the World Bank, almost as safe. Covered bonds sit in the middle, backed by asset pools on the issuer's balance sheet. Then investment-grade corporates. And at the riskier end, high-yield, or junk bonds, higher returns, higher default risk. Green bonds have identical financial mechanics to regular bonds. The difference is where the money goes. Perpetuals never mature, they pay coupons indefinitely, though issuers almost always call them at the first opportunity. For transaction monitoring, the issuer type tells you the settlement venue, the clearing house, the regulatory framework, and the expected counterparties. A government bond settling in Clearstream has a very different risk profile than a high-yield bond settling through a broker in an offshore account. When a client buys a bond or a share, that's their decision. But what happens to that investment afterwards? Most of the time, the client has no say at all. Voluntary actions are decisions the client makes: buy, sell, subscribe. Involuntary corporate actions are decisions the issuer makes, and the client simply receives the consequence. A coupon arrives whether the client asks for it or not. A stock split doubles their position overnight without a single instruction from them. This distinction is fundamental for transaction monitoring. When you see an unexpected large credit in a client's account, your first question is not, did the client do something suspicious? Your first question is there a corporate action that explains this? The issuer announces. The paying agent or central securities depository processes. The custodian credits the account. The client receives, without pressing a single button. Understanding this chain means you'll never confuse a legitimate corporate action credit with suspicious activity. Every corporate action we study in this module follows this logic. The issuer decides. The infrastructure processes. The client receives. Keep that in mind for every alert you investigate. Coupon payments are the most frequent transaction a bond generates, and in transaction monitoring, frequent means you must know exactly what to expect. 4 dates govern every coupon payment. The announcement date, when the event is confirmed. The X date, by before this and you're entitled. The record date, the snapshot of holders. And the payment date, when cash actually arrives. In Europe, payment is typically 1 to 3 business days after record date. The issuer doesn't pay you directly. It pays the paying agent, a bank appointed for this purpose, who distributes to custodians, who then credit their clients. This chain matters in TM. If money arrives from an unexpected entity, that's a flag. Your TM check is simple. Does the amount match what you calculated? Did it come from the right paying agent? Did it arrive on time? Any deviation, wrong amount, wrong source, wrong timing, requires investigation before you close the alert. Coupons are predictable. That predictability is your greatest tool as a TM analyst, and the first thing a sophisticated launderer tries to exploit. Maturity day is the biggest cash event in a bond's life. Everything comes due at once, and in TM, that means a very large, very expected inflow that must match exactly. On the maturity date, 2 things happen simultaneously. The final coupon is paid, same as every other coupon period. And the full face value, the principal, is returned to every bondholder. These arrive together, on the same day, from the same paying agent. Example, you hold €1 million of a 4% bond. On maturity date, you receive $20,000 in final coupon plus $1 million in principal, a total of $1,020,000, all in one payment. Not all bonds redeem in one shot. Amortizing bonds repay principal gradually, common in ABS and project finance. Each partial repayment is its own corporate action and must be tracked separately. In TM, if the redemption amount is less than expected, it could mean a credit event, a settlement fail, or fraud. Don't close the alert until the number matches exactly. Some bonds don't wait until maturity. The issuer, or sometimes the investor, has the right to end it early. In TM, this creates a large unexpected cash event that you must immediately verify. The call option gives the issuer the right to repay early. Companies use it when interest rates fall. They call their expensive bonds and reissue cheaper ones. For the issuer, it's refinancing. For the investor, it's bittersweet. You get your money back, but you must reinvest at lower rates. Every callable bond has a call schedule defined in its prospectus, specific call dates and the price at which the issuer can redeem. This is always at or above par, a small premium to compensate investors. The put option flips it. The investor can force early repayment, usually when they'd rather have cash than hold a below-par bond. And a make-whole call lets the issuer redeem anytime, but the price is set by formula to make the investor whole. TM check for early redemptions. Find the published call notice on Bloomberg or the trustee site. Verify the amount matches the call price, not par. And check that the cash landed in the right account. No notice, no match, escalate. A bond repurchase is when a company buys its own debt back in the market. No special rights needed, just a decision and capital. Companies do this to reduce debt, or to buy back their bonds at a discount. It also helps restructure debt maturities and signals financial strength to the market. A tender offer is a public announcement to buy back bonds at a set price, usually above market. Investors then decide to sell. The process is transparent and voluntary. Open market repurchases are quieter, done via brokers over time. In a Dutch auction, bondholders submit their own minimum price. The issuer fills orders from the lowest price up until their target is reached. In TM, large sell orders may just be a tender offer. Always verify before flagging. And watch for wash trading. Not all bonds pay the same amount forever. Floating rate notes reset with the market, while step-up bonds increase on a schedule. If your TM system doesn't track these changes, you'll generate false alerts on every single payment. A floating rate note resets its coupon every period. In Europe, it's usually Euribor plus spread, fixed 2 days before the period starts. Higher Euribor means higher coupons. The observation date is the critical trigger for this market-dependent change. Step-up bonds are different, the increase is pre-programmed at issuance. No market dependency, just a fixed schedule to incentivize calls. When a rate resets, the amount changes. If your system looks for the old rate, it triggers a mismatch alert. Always check for reset or step-up events before investigating. Update your records accordingly to stay calibrated. Keep your TM system synced with current coupon rates, not just the issuance rate. Stay accurate. Once a bond is issued, its terms are locked. Changing them requires bondholder permission via consent solicitation, a process that creates unique cash flows. Usually, companies do this to avoid default by extending maturity or waiving covenants in exchange for a fee. Healthy companies also use it for strategic restructuring or removing restrictive terms. The process is formal, issuers announce changes and bondholders vote. Winners receive a small consent fee, typically 0.25 to 1% of face value. In TM, these look like odd credits from unfamiliar agents. Verify the ISIN against published notices before flagging. If no announcement exists, investigate immediately. Consent fees are common but specific. Know how to verify them, and know when something doesn't match. A credit event is the worst for a bond. The issuer can't pay. What comes next determines recovery and generates a cascade of tasks. The main event is failure to pay, when an issuer simply misses their payment. Restructuring involves changing terms against investors' interests, often triggering CDS. And bankruptcy, formal insolvency, where bondholders join a queue of creditors. Recovery rates vary by seniority. Senior secured bondholders recover the most. Subordinated holders often receive very little, while equity is typically wiped out. Banks with CDS protection on a defaulted issuer will receive a large settlement. In monitoring, match this inflow to a contract, or it looks like an anomaly. Confirm the event, identify CDS triggers, watch for distressed buyers, and document everything. We just covered bonds, where you lend money and expect it back. Now let's flip the model entirely. With equities, you don't lend. You buy a piece of the company. You become an owner. A share is a unit of ownership. Buy 1 share of a company with 1 million shares outstanding, and you own 1/1,000,000th of that company. You benefit when it grows, your share price rises, dividends are paid. But there is no promise of repayment. No fixed coupon. If the company fails, shareholders are last in line. 2 main types. Common shares, the standard, give you voting rights and participation in profits, but dividends are never guaranteed. Preferred shares pay a fixed dividend before any common shareholder sees a cent, and they rank higher if the company is liquidated. No voting rights in most cases. When a company first sells shares to the public, it's called an IPO, initial public offering. From that moment, shares trade freely on the stock exchange. Market capitalization, price times shares outstanding, is the market's total estimate of the company's value. Bond, you lend. Equity, you own. That single difference changes everything about the risk, the return, and the corporate actions the instrument generates. A share price changes every second markets are open. What drives it? Supply and demand, but behind that, something more fundamental: what investors believe the company is worth. Four forces move equity prices. Earnings: if a company beats profit expectations, its price jumps. Revenue growth: investors pay a premium for companies growing fast. Macroeconomics: rising interest rates compress equity valuations across the board. And sentiment: markets can overshoot in both directions, driven by fear or greed. The price-to-earnings ratio is the most used valuation metric. A P/E of 20 means investors pay €20 for every €1 of earnings. High P/E reflects growth, low P/E suggests distress or value. In TM, patterns before earnings can indicate insider trading. Prices reflect expectations. When trading precedes events, the question is, what did this client know, and when did they know it? Clicking buy on a stock doesn't mean instant ownership. Settlement is the behind-the-scenes legal transfer. This timeline is critical for operations. In Europe, settlement takes 2 business days, T+2, while the US moved to T+1 in 2024. Europe targets T+1 by 2027. It's when cash leaves and shares arrive. Failed trades: when sellers don't deliver, trigger penalty interest and buy-ins. Each step generates extra transactions your monitoring system must track. Short selling is more complex: investors borrow shares first, sell them, then buy back cheaper to profit. Every step needs careful tracking. Trade date is the agreement, settlement is the reality. Know these timelines, they explain much of the activity in equity accounts. Module 3 complete. A client decides to buy shares in a company. That's their choice. But from that moment on, a series of events will happen to their investment, and they control none of them. The client decides 2 things: when to buy, and when to sell. Everything else is decided by the company's board. The dividend is declared without asking shareholders. The split happens overnight. A merger converts shares whether you agree or not. New shares from a spin-off appear in the account without a single instruction from the client. This is the single most important concept for a transaction monitoring analyst working with equities. When you see a position double overnight, or a new ISIN appear, or a large unexpected cash credit, your first question is never, what did the client do? It's, what did the company announce? Train yourself to check the corporate action calendar before you investigate any equity account anomaly. Bloomberg or your custodian feed will show every event. If the anomaly matches an announced event, document and close. If it doesn't match anything, that's when you investigate. The client chose the stock. The company chose everything else. Know the difference, it will save you hours of false positive investigations. Dividends are the most frequent equity corporate action, and the most misunderstood. For dates govern every one. Miss any, and your reconciliation will be wrong. Declaration date, the announcement. Ex-dividend date, the cut-off. Record date, the snapshot of who holds. Payment date, when cash actually arrives. In TM, the payment date is when you look for the credit. Most dividends are cash, a fixed amount per share. Scrip dividends deliver new shares instead via free of payment. The client's value stays the same, but the form changes. Special dividends are larger one-offs, verify against announcements. DRIPs automatically reinvest dividends, generating a credit offset by a small buy transaction. Check positions on the record date to calculate expected credits. If anything is off, investigate before closing. Overnight, a position triples. No purchase, no instruction. Is this suspicious? Likely not, it's just a stock split. A split divides shares into more slices. Total value stays the same. A 3-for-1 split turns one €300 share into 3 €100 shares, improving liquidity and accessibility. The math is simple: shares quadruple, price quarters. In TM, checking the corporate calendar is critical before flagging these jumps as anomalies. Reverse splits consolidate shares. Price rises, often to avoid delisting. This can signal financial stress, so context is vital. Multiplied? Check for a split. Reduced? Reverse. Even fractional residuals are normal. Corporate actions, explained. A rights issue is a complex corporate action where clients have a choice to make. But notice, they didn't ask for this choice. The company gave it to them. To raise fresh capital, companies often offer existing shareholders first refusal. This is a rights issue. For every 5 shares held, you can buy one more at a discount, like €8 instead of the market price of €10. You have the right to buy, but notice, you never have the obligation. 3 paths. Subscribe, pay the subscription price and receive new shares to maintain your stake. Sell the rights, trade them on the exchange for cash and receive the discount value immediately. Or do nothing, the rights expire and your ownership percentage of the company is diluted. In transaction management, rights issues generate different flows based on what the client chose. A cash outflow is a subscription, a cash inflow is a sale, no transaction and dilution means a lapse. The company issued the right, but the choice is yours. Track all 3 possible outcomes carefully. A share buyback is the company spending its own cash to buy its own shares from investors in the market. It's one of the primary ways companies return value to shareholders, and it generates specific patterns that a TM analyst needs to recognize. 4 reasons. Earnings per share goes up when the share count falls, same profit, fewer shares. Buybacks are tax efficient compared to dividends. They signal management confidence. And they offset the dilution created when employees exercise stock options. Open market repurchases are gradual and quiet, the company buys a small amount each day through a broker. Subject to regulatory volume limits under MAR. Tender offers are public and fast, the company names a price, and shareholders decide whether to sell. In TM, a buyback tender offer causes clients to sell large equity positions at a premium to market price. That's entirely normal, if you can confirm the tender offer was publicly announced. If a client sells shares at above market prices with no corresponding tender announcement, that requires investigation. Shares returning to the company, expected and legal. The key in TM is verifying the price matches the announced terms. Premium price without announcement is the flag. M&A is the most dramatic corporate action. One company vanishes, replaced by cash or new shares. But for TM, the real story starts weeks before the announcement. Deal structures vary, all cash turns positions into credits, all share exchanges them for acquirer stock, mixed deals do both. It's involuntary, the boards decide, and shareholders receive. At 90% ownership, the acquirer can force a squeeze out. Minority holders are compulsorily acquired at the deal price. You cannot hold, the shares are simply cancelled for cash. The red flag? Unusual accumulation before the news. A major purchase in a target company days before a jump, with no prior history, is a classic insider trading pattern. File an alert. Post-news conversions are normal. Pre-news accumulation is a red flag. Success in TM means knowing which side of the date you're on. One morning, a client opens their portfolio and finds shares in a company they've never heard of. They never bought them, and never instructed an acquisition. This is not fraud. This is a spin-off. A spin-off happens when a company separates a business unit into an independent, publicly listed entity. The parent company's shareholders receive shares in the new company proportionally, automatically, via free of payment. No cash is paid. No instruction is needed. The new shares simply appear in the client's account. If a client holds 15,000 parent shares and the ratio is 1:5, mechanics are simple. On the effective date, 3,000 new shares appear. A new ISIN is registered and it begins trading. The client did nothing, the parent company's board made this decision for all shareholders. In a carve-out, the parent sells a slice of the subsidiary via an IPO while keeping control. A split-off is different. Shareholders choose to exchange parent shares for subsidiary shares. It's voluntary. When this happens, verify the event against Bloomberg or your custodian's corporate action feed. Confirm the FOP matches the announced ratio, ensure the new ISIN is correct, and close the alert. It's a standard pattern in transaction management. Stick to the ratio, and track the new entity. Shareholders are owners. And at the general meeting, they exercise their right to shape how the company is run. From electing the board to approving dividends and auditors, these 5 core decisions shape the company's operation and financial future. Most institutions don't attend in person. They use proxy voting, transmitting instructions through custodians to a proxy agent who executes the vote on their behalf. The red flag? Empty voting. When a client borrows a massive position via FOP just for the record date, then returns it immediately after, they've voted without any real economic exposure. Proxy voting itself isn't a transaction, but the lending mechanics behind it are. Watch for that specific FOP pattern, it warrants a closer look. You've now covered every major equity corporate action. Let's close this module with the one framework you'll use every single day as a TM analyst. 7 steps. Identify the event. Verify entitlement. Calculate the expected amount. Match it against the actual transaction. Check the counterparty. Document everything. And escalate any discrepancy, regardless of how small. Here is the core truth of equity corporate actions in TM. The client did not generate most of the transactions you'll investigate. The company did. A position that doubled, cash that appeared, new shares from an unknown ISIN. These are events the issuer created, processed through infrastructure, and delivered to the account. Your job is to confirm they match what was announced. 3 red flags that always require escalation: wrong amount, wrong counterparty, or transactions that arrive before the official event date, which may indicate advanced knowledge or prepositioning. Module 4 complete. Next, free of payment, where bonds and equities both move without cash, and AML risk is at its highest. Every securities transaction has 2 legs, a securities leg and a cash leg. Free of payment breaks that link, and that's why it's one of the highest risk transaction types in AML compliance. In delivery versus payment, the standard for all market trades, the seller delivers securities and receives cash simultaneously. Neither party takes risk. If one leg fails, neither settles. This is the safe default for all exchange-traded securities. Free of payment, the securities move from one account to another, but no cash moves simultaneously. The cash may move separately, or not at all. FOP transfers financial value without an obvious cash trail, requiring careful AML scrutiny. FOP exists because not every movement involves a sale. Moving bonds between your own accounts requires no cash. Lending shares to a hedge fund or posting bonds as collateral to a clearinghouse are legitimate, routine FOP flows. FOP is legal and common, but higher risk. We'll cover legitimate scenarios and red flags in both bonds and equities. Most FOP instructions for bonds are completely routine. The client already owns the bonds. They're just reorganizing where they're held. No sale. No purchase. No cash. Just movement. An internal transfer is the simplest FOP. The client moves bonds from their trading account to their custody account within the same institution. Nothing has been bought or sold. The client still owns the bonds. No cash changes hands. In TM, verify that both accounts belong to the same client, then document and close. A custodian change is the largest FOP event in bond markets. When a client decides to move their entire bond portfolio to a new bank, every single position must be transferred via FOP, sometimes hundreds of instructions on the same day, covering hundreds of millions in face value. There is no cash, because no purchase is happening. The client already owns the bonds. They're just moving the address. For a custodian change in TM, you need a signed transfer authorization. You need to confirm the receiving accounts belong to the same client. And if only some positions transfer, not the full portfolio, ask why. Selective FOP of specific bonds without explanation is a red flag. Large FOP does not mean suspicious FOP. Context determines everything. Same client, documented instruction, full portfolio, routine. Partial transfer, unverified destination, no documentation, investigate. Securities lending drives massive volume. A pension fund lends bonds, a hedge fund borrows them. Cash moves separately. Every leg of this transaction must be understood. At the opening of a loan, bonds leave via FOP while cash collateral arrives separately, typically at 102% of market value. During the loan, a lending fee accrues, and margin calls may require additional FOP movements if bond prices shift. At the close, bonds return via FOP, cash collateral is returned to the borrower, and the final lending fee is paid. Why borrow? To short sell. A hedge fund borrows via FOP, sells at today's price, and waits for the price to fall. When the price drops, they buy the bonds back cheaper and return them. That profit difference is the goal, and the borrowing is always FOP. In monitoring, every bond leaving via FOP must match a cash receipt or a documented agreement. Unexplained movements require immediate investigation. Value cannot leave an account without an economic explanation. Securities lending generates pairs, bonds out, collateral in, then bonds back, collateral out. If you only see one side of the pair without the other, something needs explaining. Repo markets and central counterparties generate more FOP instructions per day than almost any other source. Understanding this infrastructure is essential for distinguishing routine operational flows from genuine anomalies. A repo is economically a secured loan. Bank A borrows cash, using bonds as collateral. The opening and closing legs are DVP, both sides settle simultaneously. But during the repo, if the bond's value falls, Bank B demands more collateral, a margin call settled via FOP. Or Bank A may swap one bond for another, a substitution, also via FOP. The opening and closing legs are DVP, but secondary flows like margin calls or substitutions are settled via free of payment instructions. In tri-party repo, a neutral third party, Euroclear, Clearstream, or BNY Mellon, manages the collateral portfolio between the two banks. Every morning, the agent checks market values and concentration limits, then rebalances automatically. This generates hundreds of FOP instructions daily, all routine and expected. Central counterparties require margin, both initial margin when a position opens and variation margin as markets move. All of this is posted and returned via FOP. A bank's CCP margin account generates constant FOP movement simply by having open derivatives or repo positions. Repo margin calls. Tri-party rebalancing. CCP margin. These three sources generate the majority of routine FOP volume. Before flagging a bond FOP as suspicious, check these infrastructure flows. Not just a bond concept. In equity markets, free of payment instructions are generated constantly, by portfolio reorganizations, corporate actions, and securities lending. The mechanics are identical. The context is equity. When an asset manager merges two funds, every equity position in the absorbed fund must be transferred to the surviving fund via FOP. The manager is moving their own clients' assets between their own vehicles. No sale, no purchase, no cash. In TM, a mass FOP of equity positions from one fund to another on the same day, with a fund merger board resolution on file, is entirely routine. Several equity corporate actions generate FOP deliveries. A spin-off delivers new shares via FOP, no cash. A scrip dividend delivers additional shares instead of cash, FOP. A merger settled in shares converts target shares to acquirer shares via FOP on closing day. Each of these generates FOP flows that look unusual until you link them to the underlying corporate action. When equity shares arrive via FOP with no corresponding purchase, always check the corporate action calendar first. A new ISIN you've never seen is almost always a spin-off. A small increase in an existing position via FOP is likely a scrip dividend. Verify the ratio. If it matches the announcement, close. If it doesn't, investigate. FOP in equities follows the same logic as bonds: document who sent, who received, and what the economic rationale is. For corporate action FOP, the rationale is always published in advance. Your job is to link the instruction to the announcement. Securities lending works exactly like bond lending, but the motivation for borrowing is almost always the same: the borrower wants to sell the shares short. Understanding this closes the loop between FOP and short selling. The life cycle: the pension fund lends shares via FOP and receives cash collateral. The hedge fund sells the shares in the market, generating a standard DVP equity sale. When the price falls, the hedge fund buys back cheaper, returns the shares via FOP, and the lender returns the collateral. The FOP is the borrowing mechanism. The short sale is the trading strategy. The profit is generated by the price difference. The TM pattern for legitimate equity lending plus short selling: shares leave via FOP, and the same ISIN is sold in the market shortly after. Both legs are covered by a documented securities lending agreement. The presence of a market sale immediately after an FOP outflow is the expected mechanic. The risk: the same transaction pattern can exist without any lending agreement. If shares leave via FOP with no documented arrangement and no collateral received, the FOP may have been used for an undisclosed short sale or to move value without transparency. No documentation changes everything. Equity lending FOP: always verify against a securities lending agreement. FOP out plus market sale equals normal when documented. Without documentation, it's a red flag. A large portion of all free of payment instructions are generated automatically by financial infrastructure, not by clients at all. Understanding this prevents an analyst from flagging thousands of legitimate, system-generated movements. Central securities depositories are the electronic registers of ownership. Every bond and share exists as a book entry at a CSD. When positions move between two accounts at the same CSD, it's an internal FOP, a simple book entry update with no physical movement and no cash. Target 2 Securities is the ECB's pan-European settlement platform. It connects national CSDs across the Eurozone and processes millions of book entry transfers every day. These flows are system-generated, automated, and entirely routine. Every bank with open positions at a central counterparty generates daily FOP flows for margin. When a position moves against you, the CCP calls for variation margin, which is posted via FOP. When you close a position, excess margin returns. This volume is enormous and automated. Before flagging any FOP as suspicious, ask: is this a CSD book entry? A T2S transfer? Or a CCP margin call? Infrastructure flows account for the majority of FOP volume. Always look for the context first. Covered every legitimate FOP scenario for bonds and equities. Now let's talk about when FOP is not legitimate, when it's used to move financial value without a visible cash trail, and exactly what that looks like in a TM system. 8 red flags. An unrelated third-party destination. Immediate liquidation after receipt, the classic layering pattern. Circular movements with no purpose. High-risk jurisdiction counterparties. No documented business rationale. Positioning before a cash event. A sudden volume spike from a previously quiet account. And when the cash is inconsistent with the market value of the securities transferred. The bond layering typology: criminal buys bonds with dirty cash, transfers them via FOP to a shell company, no visible cash transaction, and the shell sells the bonds for clean proceeds. The FOP is the mechanism that severs the audit trail. What you see, FOP out to an unrelated account, followed immediately by that account selling the same ISIN. In equities, empty voting. A client borrows shares just before the AGM record date, votes them, and returns them immediately after. The FOP pattern is unmistakable: large inflow, hold through record date, large outflow. No dividend collected. No long-term position. Report to compliance. Every FOP instruction needs a business rationale. Internal transfer, custodian change, securities lending, collateral, corporate action, These are your legitimate categories. If an FOP doesn't fit any of them, and the client can't or won't explain it, that's your escalation trigger.